All models are wrong, but some are useful. This tongue-in-cheek phrase is attributed to George Box, but in reality he was poetically expressing a commonly known problem in statistics, that all statistical models eventually fall short of reality. About 6 months ago, banks and analysts published price targets for gold, silver, and platinum. Then Donald Trump raised his right hand on Inauguration Day and sent a jolt through every trading desk on the planet. Now that we're halfway through the year, it's time to hold those shiny forecasts up to the light and see which ones still have a pulse, and which have already been consigned to the scrap heap of market history. If you're invested in precious metals and want to understand the markets without the hype, this is the one channel you should subscribe to. Hitting that subscribe button is the best way to keep our channel alive and ad-free. Thank you. Those of you who have been with us for a while know that we like to zoom out and show the macro picture a little more clearly. But today we're doing the opposite. We're zooming in. Why? Well, normally gold, silver, and platinum don't move very fast and very far in short windows. That has not been the case for the year 2025. Year to date, gold is up 26%, silver is up 25%, and platinum is up almost 50% at the time of writing. Stocks are struggling with gains in the low single digits, bonds have had a decent year, and crude is down about 9%. The US dollar index is wavering with every shift in policy from 1600 Pennsylvania Ave. At the start of the year, gold had the most eyeballs on it. Its performance in 2024 was nothing short of spectacular, starting the year at $2,076 per ounce and ending it at $2,606. And yet analysts believed that gold would take a pause to catch its breath. JP Morgan projected gold prices to rise to $3,000 an ounce by late 2025. UBS expected the metal to close out 2025 at $2,850 per ounce. In the LBMA's analyst forecast, which compiles the best estimates of 30 professionals, not a single one expected gold prices to exceed $3,300. The most bullish analyst of the group targeted an average price for the year of $3,075.05. The current price of gold is $3,330 per ounce, and it has already set a new all-time high for 2025, topping out just over $3,500. Gold forecasts missed badly this year. Unless prices recede in the second half, we're looking at another historical year following on the heels of 2024's amazing run. Silver is a little different. While it has generally outperformed, it has not surprised to the degree that gold has. Partially, this is because silver historically follows gold prices on a lag, whether that's up or down. With gold's 2024 showing, experts assumed silver would move spectacularly this year in response. And they weren't wrong. JP Morgan predicted silver reaching $38 by late 2025, and UBS held a similar line at $36 to $38 per troy ounce. In the LBMA price forecast, 14 out of 30 predicted silver reaching over $38 per ounce, and several predicted silver reaching over $40 per ounce. The most bullish analyst, Nikki Shields with MKS PAMP, is also the closest to the current price. Her forecasted average of $36.50 for the year is only 39 cents different from today's spot. And that brings us to platinum. We've covered this topic extensively in recent videos, but it's safe to say that forecasters this year were caught without their crystal balls. Platinum has traded several times above $1,400 an ounce, far outstripping almost every forecast made at the beginning of the year. Not a single analyst in LBMA's forecast expected platinum prices to accelerate this way. JP Morgan predicted $1,200 an ounce by year's end on tightening mine supply and ETF inflows following the Fed's first rate cuts, which have yet to materialize. And UBS staked out a mildly positive stance for platinum to top out near $1,100 per ounce, though some of the bears clustered around $920. A sustained breakout was not in the cards for anyone. Why are the models, especially for platinum and gold, so far off the mark? Are the models really that broken? The answer is that models rely on predictability, and precious metals thrive on the unpredictable. If you can predict an event, you can model it. The model may vary in its accuracy, but you can't model very well for an event you don't expect. President Donald Trump is very good at doing the unexpected. Most of the models made earlier this year took into account his stated policies and positions, and made some assumptions about the most likely outcomes. Some of the respondents noted that U.S. monetary policy, central bank buying, and geopolitics were three levers that would influence price action this year. Everyone understood that tariffs were a live option, but few foresaw just how sweeping they would be, or how long the policy fog would hang over the market. Precious metals thrive on seamless global circulation, so the mere threat of country-by-country duties jolted the entire ecosystem. Lease rates for gold, silver, and platinum shot higher, and in some cases have stayed stubbornly elevated. A fat arbitrage spread opened between London and US inventories, handsomely rewarding anyone nimble enough to shuttle physical bars across the Atlantic. Traders and refiners have been busy rewiring supply chains and layering on hedges ever since, still bracing for the next curveball from the negotiating table. Platinum is the powder keg right now. Physical supply is so tight that a normal safety valve, the big ETF holders cashing out, has jammed shut, because most of those funds bought near $14.50 in the last run-up, and they are still underwater. Until they can at least break even, nobody should expect fresh metal to flood the market and cool prices. Silver is telling a similar story. It is grinding through a 6th straight year of deficit and has slipped into backwardation more than once in 2025. Another red flag that inventory is running thin. Put shortages together with tariff friction, and the forecasting models never stood a chance. They caught the direction, but missed the pace. The entire precious metals complex has already blown past every early year target, and we are only at the halfway mark, forcing analysts to chase the rally with ever higher numbers. There are two lessons we should engrave in stone. The first is that all models are wrong, while some are useful. Just as the aphorism goes, treat your metal forecast the same way you do your weather, with just a hint of suspicion. The second takeaway is a bit juicier. We're not seeing temporary flare-ups in metals, we're seeing tectonic shifts that may permanently raise the floor. A true short-term geopolitical swing, like the Israel and Iran conflict that recently played out over nuclear arms, does have an impact on prices. But as soon as the fighting cooled and tensions unwound, so did prices. Chronic mine shortfalls are finally starting to show up in the numbers as physical reality asserts itself in paper-dominated markets. Tariffs are the opening act to rewriting global trade balances. Do you believe the next administration will come in and undo all the new regulations? Let history be your guide. The Biden administration kept most of the tariffs from Trump 1.0 and added new ones of their own, expanding the tariff regime. It may not have made headlines, but substantive changes to international trade are not so easily undone. These are structural changes occurring today, and they are setting the pace for many years to come. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.